Market structures really refer to the different industries that are classified and that are differentiated based by a degree of competition for the goods and services. For this class, I'm going to dominate on the 4 types of market structures. We have the perfect competition, we have the monopoly, we have the oligopoly, and the monopolistic competition. So for each of these market structures, they are determined by the characteristics that we are going to look at. So these market structures are important because they will show you relationships that exist between sellers and other sellers. They also show you relationships that exist between sellers and buyers. So we'll start with the perfectly competitive market. In a perfectly competitive market, what should come into your mind is the common market that we have, so common market. We have the following characteristics from the table. Number 1, there are many buyers and sellers. Number 2, there is no product differentiation. Goods are homogeneous. So meaning at the market, you can't differentiate if this commodity, air fertilizer, this commodity is natural or organic, they're all the same, they're identical. Then the demand curve is horizontal, it's a straight line, meaning they are price takers. They're price takers. Then the size of firms is averagely very small. They're small firms. Then demand is very elastic and they make normal profits in the short run and economic profits in the long run. There's little or no government intervention. They have low price decision making. Examples are agricultural shops. Now, let me elaborate more on the perfectly competitive market from the trades that we just talked about. Number 1, the graph looks like this. The price is the same as the average revenue, which is the same as what? The marginal revenue. So this is the marginal, this is the average total cost. And this is the marginal cost cuts just half in there. Profit is maximized where the marginal revenue is equal to the marginal cost, where they meet down there. And here, the lowest point of the total average cost, this is what we call the normal profit. A, B, C, P. This is what we call what? The normal profit. So in the perfectly competitive market where many ladies would want to join selling handbags, in the short run, they're going to make this profit. As more people hear about it, they want to join the market. So what will happen is that the average total cost will go up. So making firms break even at this point. So the profit that was made here will be depleted. So we reach this point, which is called the shutdown rule. So here they'll make economic profits. So this is the marginal cost. This average total cost. And what cuts in between is the marginal cost. Okay, then this is the AR, average revenue. Until you reach the long run, where now firms are operating at higher costs. Okay, the average total cost is now on top. The marginal cost is now here. Then profit is maximized when MR is equal to MC at this point here. Put your line, your dot, join there, join there. Of course, you'll not be asked to do these graphs, but I just want you to get the concept. They will make economic losses in the long run. Now, when we are dealing with a perfectly competitive market, what you need to understand is that in this market structure, everyone is aware of the prevailing prices. And being aware of the prevailing prices, it means there is perfect information in the market. There is perfect information in the market. So the idea of perfect competition thrives on the assumption that firms will maximize their profits. There's free entry and exit to the market, meaning anyone can enter and leave at whatever time they feel like. Firms here sell goods that are totally identical. They are called homogeneous goods. There are no consumer preferences. By looking at those assumptions, we can conclude that the perfect competitive market has the following characteristics. The opposite is a monopoly. In a monopoly, what should come into mind is ZESCO, electric companies, utility companies. So here there's one major seller. There are heavy barriers to entry, meaning government has a portion of it. You cannot just come in and enter. There are a lot of restrictions involved. The good must be unique. You shouldn't have substitutes for you to be a monopoly. Then demand is inelastic. Here, demand is elastic, meaning people are very sensitive. Tomato is 1 kwacha. If you sell it at 1 kwacha 15, they will not buy, they'll switch to the neighbor because they are price takers. Information is well known, but here it is inelastic. They increase price, but people just complain. You will still buy power from ZESCO because they're the only option that we have. They make abnormal profits in the short run. You have one major firm which maximizes profits and heavily regulated by the government and the price setters. These price setters, the graphical outlook looks like this here. They are down sloping, like you said, they're not horizontal. So marginal revenue is half of the average revenue. This is our marginal revenue, this is our average revenue. Start with the average total cost. And half of this is our marginal cost. Profit is maximized when marginal revenue is good what? Marginal cost. At this point here, put a dot. Trade upwards, that is there. This is the abnormal profit that is made in the short run. So this is how the curve in the monopoly looks like. So under monopoly, mentioned that the market structure has a single firm that controls the entire market. The firm has the highest level of market power. Consumers have no other alternatives. Assumptions are that number one, it maximizes profit. Number two, it's a price setter. Number three, there are huge barriers to entry. Number four, there's only one major seller that dominates the market. From this perspective, we also gave graphical implications that the curve of a monopoly looks something like that. So they are established firms that have economies of scale. If you want to join in, they will lower their market prices to put you off the market. Then we have another market structure, which is called monopoly. Monopoly here, few firms join to form what is called a cartel, where they will interdependently regulate prices, how much to whom must be sold. Firms are few and large, demand is elastic, and they make normal profits in the short run and economic profits in the long run. Their sizes are medium to high, they are price setters. Examples are automobile companies. They demand curve has a kink. By a kink, it looks like this. This is how the graph looks like. Because there are two firms that make together, the decisions are interdependent, so they make decisions within the marginal revenue gap. The implications of this marginal revenue gap is that if they all agree to sell at 3 kwacha, and you are selling at 5 kwacha, they'll leave you off the market to make a loss. But if you sell at 2 kwacha, they'll go below you, maybe even sell at 1 kwacha, so that they put you out of the market. This is a market structure where formally they agree on the price. The market is controlled by a handful of firms. Examples of the OPEC countries where oil is predetermined for whomsoever at whatsoever time they feel like. There is a kinked point in the demand curve where demand D1 and D2 intersect. D1 proportion of the demand curve is elastic and D2 is inelastic. When the curve is like this, it is elastic. When it's like this, it's inelastic. So this part of it is inelastic, this part of it is elastic. So it has both characteristics. They also make highly differentiated and highly homogeneous goods. What are differentiated goods? Differentiated goods are characterized by a market structure called monopolist. What comes to mind are restaurants and food chains. There are many, there's easy entry, but the commodities are differentiated. We have Unilever, Trade Kings, they're all doing toothpaste. Up to now, we think it's Colgate because it was highly differentiated. Aquafresh, Colgate, they differentiate, but it's the same toothpaste. Demand is downsloping, highly elastic, small to medium scale firms. They are elastic and they make normal profits in the short run, and there's minimum government intervention. They have little control over pricing because of the packaging and price that they have. So this is what the market structures entail. Now, you'll be told in an exam question that we have a perfectly competitive market. The price is 1,000 minus 4Q. TC is 100 plus 2Q. They'll ask you to find the marginal revenue, average revenue, marginal cost, and the profit. And maximize profit and revenue and find the level of equilibrium. So these are 3 topics in one. So perfectly competitive market. Perfectly competitive market, here we have the equation. I didn't solve that one. Why? So we have the price 1,000 minus 4Q and the total cost 1,000 plus 2Q. So 1,000 minus 4Q, that is your demand in the perfect competitive market. 1,000 minus what? 1,000 minus 4Q. The total cost is 1,000 plus 2Q. So those of you who are in the previous class, please don't embarrass me now. How do we find the total revenue? Come on, class. What do we get? What's the formula for total revenue?
It's P times Q.
Price times quantity.
Price times quantity, good. So our price is what? 1,000. When you multiply by Q, what are we getting?
1,000 minus 4Q squared.
Minus 4Q squared. Good. This is called our total revenue. Then how do we find our marginal revenue? I said if you don't know how to differentiate, just go to the price and this part just multiplied by 2. That's all. So we're going to get 1,000 minus what? 8Q. This is the shortcut.
Sorry, you said if we don't know what?
If you don't
Then
know
you
how to
multiply by 2?
differentiate, the shortcut for finding marginal revenue,
Okay.
you go to the price function and multiply the
Mm.
2 on the coefficient of Q. So 2 times
Okay,
2 is
thanks.
8. You get this one here. And the average revenue for a perfect competitive market is the same as the price. So this price there is the same as the average revenue you saw from the graph. So just write 1000 minus what? 4Q. Okay. So can somebody tell me now? The other question was asking us, how do we maximize revenue? Who wants to lead us to how do we maximize revenue? We equate the marginal revenue to 0. So 1000 minus 8Q should be equal to what? 0. So 1000 is equal to what? 8Q when it goes to the other side. When you divide by 8, Q is equal to what? 250. And we already had our P as 1000 minus what? 4Q. Was 2Q or 4Q? 1000 minus 4Q. So when you put our 4 there, what are we having?
Collins,
Yes, please.
Q is equal to 125.
When you divide there, you get 1.5. Thank you. 125.
Yeah.
So when you put 125 here, what becomes? What are we going to find?
500.
500. Excellent. 500. So the P therefore will be equal to 500. So the Q is 125, the P is 500. So now, how do we find our profit? When we found our total revenue, what was our total revenue? 1000 Q minus 4Q squared. When we found our total cost, we've been given our total cost in the question. What is our total cost in the question? 1000. Our total cost in the question has been given as 1000. 1000 plus what?
So we're still studying the first question.
Yes. So we need to find, we found this, we found that. So now we need to find the profit. We've also maximized the revenue. So find profit, we need the cost function. So 1000 plus 2Q. 1000 plus 2Q. So calculate the profit from that. So profit, who remembers the formula for profit? Total revenue minus total cost. Total revenue minus the total cost. So you can find that at your own time and find the profit, differentiate it, equate it to 0, and find the units that maximize profit. So on the market structures, we also need to go in depth in understanding the other markets like oligopoly, how the curves look like and how to do the calculations, and monopolist, how to do the curves and calculations. I'll send you the notes on the paid up group. Those that are paid only, I can inbox you. This is important material because we'll be looking at now the assignment questions and the paper for last year based on what we have just discussed.
Collins, are you going to send this document to us?
Yes, I'll send the document here. I'll send this document.
Okay, thank you.
All right. So I'll send you some homework questions to do. I don't want to stuff you with a lot since I'm still meeting you again. So we end here.
What time are you meeting us?